Hello everyone, this is Rob McDougall from Zhang Financial here on Monday, April 15th, 2024 with your weekly economic update. As a couple of you might have noticed, last week we failed to put out a broadcast. I was actually out for the week and failed to mention that the week before. My apologies, back this week. We'll recap last week, take a look at how the markets responded to economic data from last week, and of course look at the economic data coming up this week. So last week, if you didn't pay attention, weren't noticing, inflation was the hot topic and was hotter than expected. Disappointing numbers. So that was not good for the markets, either the fixed income or the equity markets last week. We'll go through those numbers. But in particular, on Wednesday, we had the CPI come out, CPI and CPI core. Both cases, they were expected to be up month over month. March number expected to be up 0.3% month over month. Both came in at positive 0.4% month over month. Now, we ended up getting the PPI data the next day, and the PPI data was in line, a little better actually than expected. The PPI itself was up 0.2%, was expected to be up 0.3%, so that was good. But the previous day, the CPI is definitely all that mattered last week. Really hit the markets. We'll look at that again in a moment. So what happened with the CPI? Food cost were not an issue whatsoever, and that's the data point that most people point to. Go to the grocery store, it seems like that's where all the inflation is. Actually, it hasn't been, at least year to date, and particularly for the month of March, it was only up 0.1%, food cost in total. So very much a non-factor. In fact, that helped bring inflation down from where it might have been. The two that really hit were energy costs and shelter costs. So energy costs for the month of March up 1.1% month over month. That's following a February that was really high, a positive 2.3%. So we mentioned the fact, I think a couple of weeks ago, the fact that oil prices were up approximately 15% already this year. That is really working its way through the system, and so therefore we've got inflation moving the wrong direction. Also, shelter. Now, we've pointed out that shelter, 35% of the CPI is very sticky, and it has proven to be even more than we would have guessed. So it came in for the month of March, month over month, 0.4%, positive 0.4%. You have to go back to October last year, where it was below that. I think it was 0.3% month over month. So you've got shelter running at nearly a 5% annualized rate last 12 months, and that's 35% of the CPI. So not a surprise that we're running 3.5, 3.6% annualized on the CPI in total. So that happened on Wednesday. PPI numbers came out the next day, really didn't make people feel that much better. So it was a tough week. We also had the, the Michigan consumer sentiment number come out. That was expected to come in at 79, came up a little low at 77.9. Again, I don't think this is a big issue because I think, as we'll see, consumer and retail spend has been really strong. So I don't think that's a factor at all, but investors very much focused on the inflation numbers. And the CPI definitely was disappointing. So based on the economic data we had last week, the Atlanta Federal Reserve, they lowered their estimate for first quarter GDP growth to positive 2.4. That'd be a very solid quarter. Last year, I think we mentioned how strong GDP growth was. In total, it was positive 3.1%. So coming down a little bit in the first quarter, I think would be actually welcomed by most investors. In terms of inflation expectations, even after the CPI numbers last week, still very modest. The expectation for the next 10 years, inflation will average 2.39%. That's off its bottom, but that's I think, a very low number. So in terms of the Federal Reserve, and this is why the CPI number matters so much, is expectations for rate cuts. Investors coming into this year, there was a 50% probability we were going to get 6 rate cuts. That has evaporated. So expectation now for the May Fed meeting is almost no chance whatsoever of a cut, 2.3%. No chance of an increase either, but so 97.7% odds that the May meeting we get no change. Then we take a look at the end of the year, and again, coming into 2024, it was greater than 50% odds we were going to get 6 rate cuts. Completely gone. Now at this point, there's 15% probability built into the Fed funds future market that we will get no cut by the end of the year, 0. So that's a dramatic reversal of expectations, and that's investors were not happy with that. So last week, what happened based on the economic information? U.S. equities down, international equities were down, fixed income down quite a bit. So last week in the U.S., S&P 500 down 1.5%. NASDAQ actually held in better. You would think that would be weaker on a down week, but it wasn't. It's down 0.45%. So S&P 500 now for the year up about 7.9%, still a very strong number. International last week, the developed markets were down about where the S&P was down. It was down 1.36%. But emerging markets held in much better. It was only down 0.38%. And China, best of all the equity indexes that we're looking at, was only down 17 basis points last week. Fixed income, however, we had the 2-year yield up 15 basis points. We had the 10-year up 13 basis points. So the Bloomberg U.S. Aggregate Bond Index last week was down 70 basis points, and now for the year is negative 2.5%. So what really gets hit in an environment like this, of course, are long duration bonds. So the Bloomberg U.S. Long Government Bond Index, approximately 20-year duration, that was down 1.2% last week and down 7.3% on a year-to-date basis. So economic activity that will be released, or the news released this week. Today we already had retail sales month over month and retail sales ex-auto. The numbers, I don't have them in front of me, but I know they were much stronger than expected. I think it was approximately positive 1.6%, so way better than consensus. Again, that's not really favorable for decreases in inflation. The rest of the week, not anything of note, really. We have 3 indices on housing. All 3 are expected to be slightly lower than it came in for the February number. So we have building permits on Tuesday. On Thursday, and we have housing start also on Tuesday. On Thursday, we have existing home sales. All 3 of those indexes slightly lower than we had actually in February. So don't think those will be market-moving numbers one way or the other. And the last thing we have is existing claims that we have every week. Of course, investors very focused on the labor markets as well as inflation. So the expectation for the unemployment, additional new claims, is at 214,000, and the week before was 211,000. So that's it for the recap for last week and a preview of this week's economic activity. Thank you very much for joining us. We hope to see you next week. Thank you.